Central banks were not created to rule economies. They were created to stay out of politics. Their mandate was simple: maintain price stability, protect the currency, avoid discretion. Independence was not a privilege. It was a defense mechanism. Because money loses credibility the moment it becomes a political tool. For decades, this separation worked. Markets moved. Governments debated. Central banks adjusted quietly. Distance mattered. Neutrality was not about fairness. It was about restraint. And restraint was the foundation of trust. That balance depended on time. Policy moved slowly. Markets moved slower. Then speed changed. By the late 20th century, capital could cross borders in seconds. Trading accelerated. Leverage multiplied. Financial systems became tightly coupled. Crises no longer unfolded over years. They unfolded over days, sometimes hours. Supervision could not keep up. Rules lagged behind reality. The system still looked stable, but stability had become fragile. Because speed removes buffers, and buffers are where neutrality survives. In October 1987, global stock markets collapsed in a single day. No banks failed. No currencies broke. But something unprecedented happened. The U.S. Federal Reserve intervened immediately. To reassure markets it would provide liquidity. This was not written into law. It was not debated publicly. It was a signal, not to institutions, but to expectations. Markets recovered, and in that recovery, a new assumption formed. If confidence was threatened, central banks would act, not because of inflation, not because of employment, but because instability itself had become unacceptable. After 1987, intervention did not stop. It evolved. Central banks learned to improvise. In 1998, a single hedge fund threatened global markets. Federal Reserve coordinated a private rescue. No law required it. No mandate described it. But the alternative was disorder. Neutrality survived in language. Discretion took over in practice. Rules were still referenced, but outcomes mattered more. The system was no longer being regulated. It was being managed. The global financial crisis removed any remaining ambiguity. When markets froze, central banks did not hesitate. Rates went to zero. Balance sheets expanded. Extraordinary measures became standard tools. European Central Bank, the Bank of Japan, and the Federal Reserve moved in parallel. Independence remained on paper, but policy now shaped distribution, asset prices, and political outcomes. Doing nothing was no longer neutral. It was a decision with consequences. And so intervention became default. Over time, markets adapted. They stopped reacting to fundamentals. They started reacting to signals. Press conferences mattered more than rates. Language mattered more than policy. Central banks became narrators. Stability was no longer produced by rules. It was produced by belief. Expectations anchored markets. Until they didn't. This was not manipulation. It was dependency. When systems grow too large to fail, neutrality becomes impossible. The transformation was not limited to one country. In Europe, monetary policy replaced fiscal unity. In Japan, intervention became permanent. In emerging markets, credibility depended on alignment with global liquidity. Central banks became political not by intention, but by necessity. They filled the vacuum left by slow governments and fragile institutions. Power moved where action was possible, and action required discretion. Central banks did not lose control. They lost the option to remain neutral. Every intervention stabilized the present and narrowed the future. The system works, for now, but stability achieved through constant presence. Has no clear exit. Neutrality once protected trust. Now trust depends on intervention. And that is not a technical condition. It is a political one.